Have you noticed how hard it's been lately to purchase a home? It's not just the interest rate, it's not just the inventory, it's not even just the prices. It's like everything's working together against us. One of the questions that we often have is why, and we'll go over that. But one of the more important questions that we want to work towards is, well, what do I do now? Because the prices are there. So what should I do? Should I stay put? Should I move? Should I sell? How do I maximize things? And we'll go through all that today in this video. Hey, I'm Dre Griggs with Obsidian Wisdom. I specialize in people 5 to 10 years from retirement, maximize their retirement by adding more wisdom and less worry. So when it comes to setting up your retirement, when we're talking about the affordability crisis, let's start with what's causing it. So first and foremost, you might remember that there was a spike in housing prices. And when you're trying to figure out what caused that spike, there's multiple things when we talk about from an economic perspective. One of the main things is we're paying more for the house. And so you can see that nearly 6,000 US homes back in 2002 sold for over $800,000 on asking price, which means that when I'm using comparables to price my home, if my neighbor said, "Hey, you know what? All our homes are worth $400,000," and then they sold their home for $500,000, $550,000, $600,000. Guess what price my home is going to be listed at when I sell it? You're right. I'm not going to list it at 400,000. I'm going to list it at that 550, 600,000. And now what some people will say is, well, Dre, of course that was a one-off, but how many one-offs do you have to have before something is just the norm? And you can see that back in 2021, 2,400 homes were sold for at least $100,000 over asking price. We're almost three times that at 6,000 homes for 2022. And you may or may not remember at that time, we were just kind of getting off of COVID. We had the stimulus checks, we had the very low interest rates because we're worried about a recession. We had a mixture of things going on, people switching jobs where they were getting 20, 30% raises. And then when you put all this together, people getting more money that they had left over from their stimulus check, and you had people that had zero or very low interest rates. This is the type of things that are creating those high inflationary environments. If I have extra money, what am I probably going to do with it? I'm probably going to spend it. And that's what people did. They spent that money, and then that raised the price of all the things in the market. Now, this is important to note because you can see this is done from the US Treasury. And while you can see that wages have been relatively flat for decades, and you can see that we started seeing an increase, but it doesn't nearly keep up with the housing prices. So all of a sudden, people are trying to get houses in a market that their wages haven't gone up. Not to mention, also people started dealing with rent. And so you see that Florida has a decent number of issues that we're trying to tackle at once with our housing prices. We have natural disasters and increase in property insurance that they're either charging us more or the people aren't moving here. We also have a low inventory, and the low inventory is driven by a couple things. One is people are buying the affordable houses and then they are using that in their investment portfolio, and you can see that right around the area I'm at, that Jacksonville has an affordable housing landscape that's reflected in the overall nation. Well, what do they mean? They say all income levels lack affordable housing, yet housing construction and land costs remain high. Okay. It says the housing market is much hotter than 4 years ago. They said prices are coming down, but they are not coming down. Right? Okay. So they've gone high, but they're not reducing. We just talked a little about that. If I know my neighbor sold at a certain price, do I want to do that? They said, well, what are some of the things causing that? And you see, they said one of the biggest challenges is the decrease in affordable housing supply. What do you mean? We're saying that the lower price houses are being purchased by institutional investors and that they make up 21% of the rental market. So you're probably like, okay, well, what does that mean, Dre? It means that the affordable housing is being purchased by large banks, insurance companies, hedge funds, things like that. And then they are now renting these houses back to the people who would normally buy the affordable housing. And so you can see that in Jacksonville and Florida throughout that this is a big problem, that not only is the insurance high, not only do we have all the hurricanes, but we have a low amount of affordable housing where people are buying their vacation home or the rental home because they know people like to travel to Florida. That's happening at other places as well. So you have a low inventory, and then you have people that are raising the rent that's outpacing wages. So if I have rent and I raise my rent 5% every year, well, people aren't getting a 5% raise every year. If I have rent and I raise it 10% every year, again, we're not getting a 10% raise every year. And most people are getting somewhere between a 1 to 3% range. And if you are retired and living on a fixed income and it's tied to a cost of living adjustment or something like that, then you're definitely not going to be seeing the same increase that you might be seeing with some of these rental rates. And the last cause of the housing prices that we'll focus on today is naturally the interest rates. So when you're talking about the interest rates, there's a couple of things that does. One is it definitely lowers the inventory. What I mean is if I have the 3% interest rate right now, you can see on this chart that if I have a $500,000 house and I have a 3% interest rate, if I locked it in during the lowest of interest rate times, you can see that I will be paying $2,000 a month for my mortgage. Well, if I am trying to sell my house and I then have to purchase a house in the same environment, I'm going to be paying closer to a 6% interest rate. And you can see that that's almost an extra $1,000 a month that's added on to my mortgage. That would be a concern if I'm deciding to move. I'm basically like, hey, I'm trying to downsize, I'm trying to make a move. I want to be able to have a smaller house and a smaller monthly payment. But you can see that you're not actually getting a smaller monthly payment just by selling your house and buying a smaller house. I might actually have the same monthly payment that if I downsize and get a smaller home, but I have a higher interest rate, then the difference from a 3% to a 6% interest rate is an extra $1,000 a month. That would be much more difficult for me to make up on how much of a home I can get. I still have to have some sort of a home. I don't want to live in a one bedroom studio apartment, but I wanted to downsize. When that is part of the calculation, a lot of people are now saying, well, based on that, I'm going to stay in my house, which is what a lot of people are doing. I'm not going to move unless I have to move. Well, that impacts the inventory that we have. That also causes a lot of the bidding wars and everything. And then it also leaves room to the institutional investors. We're like, hey, this is sitting on the market. The price is going down. No one's buying it. We'll go ahead and buy it and build our portfolio from it. All of these are factors that we would be needing to consider when you're talking about, hey, what is causing the housing crisis? Now, when you're talking about why this matters, there's a few things that we would need to consider. Number one is it makes it difficult for first-time home buyers. That you can see the numbers just 5 years ago. The average home was about $200,000 that people were able to move into. That price is close to double now. That there is a spike in the number of people who are living with their parents in their 20s, that there is a decrease in the number of people who are buying. There's an increase in the number of people who are renting because we're looking at these prices and it's like, I can't break into the market with what the wages currently are at my entry level, even if I just graduated from college, versus how much I need to make to afford my first home. And so that is becoming an issue for people who are first time home buyers. Next, as we just started talking about, retirees can't downsize quite as easily. It's not as simple as I'm just going to get rid of my 4 or 5 bedroom home because all my kids are gone to having a one, two, maybe possibly a 3 bedroom home. And I'm going to have a lower monthly payment. That's not as much of a slam dunk right now. That you can go from a 4 bedroom home to a 2 bedroom home and actually increase what your monthly payment will be based on what your interest rates currently are. And of course, what people are paying and the price for these different items because the prices are going up and the interest rates aren't helping either. The third reason this matters is because people who are renting longer. That it might be this idea that, well, interest rates are high. I'll just wait for them to go back down. Inventory is low. I'll just wait for it to go back up. I'll sell my home and I'll rent for a year or three, and we'll just kind of see what happens when the market goes back and it becomes a buyer's market again. I will then take advantage and I'll purchase my home. There are some people that have been sitting at rents and now their first set of rent. So let's say your normal rental contract might say, hey, we're going to give you this amount and it's good for 2 years, it's good for 3 years. But after that, it's going to be reset to the market. So you're like, no problem. I had 3 years, not an issue at all. Now you're sitting there and it's getting close to that 3 years. And you're like, the market hasn't changed. We're still in a housing crisis. The prices haven't gone down. That even though people aren't buying homes as readily as they were, people aren't bidding at $100,000 over asking price. The price of the homes haven't come down. So now you're sitting there and you're like, all right, do I take the increase in my rent, which isn't matching my income, or do I go and try to get a new home in this market? And then this also matters for you because there are some people who are going to say, I'm using my rental income from these properties, and now it's slightly more difficult for me to enter the rental market. That there are the 40 houses that I was going to get at 2 or 3 of these. I was going to charge a monthly rent, and then I was going to use that to fund my retirement income. Right. I'm going to be good to go. But if I'm now having to bid against these institutional investors, if I'm now bidding against these hedge funds where they're starting to buy up blocks and they're grouping them together, I don't know if I'm able to compete. The price for me to enter the rental industry has now increased which naturally is going to be difficult if that is one of the three streams of income that you were thinking of using in your own personal retirement plan. That leads us into the third section is, all right, well, Dre, if all this is true, ultimately, what should I be doing now? And we're talking about what we should be doing now. It's a reminder that the circumstances don't determine the outcome for us personally. And what I'm saying is, and I often we use the same example, in a time of economic growth, there will be at least one company that files for bankruptcy. In a time of the Great Recession, there was at least one company that made more money that year than it had ever made in its entire existence. That the circumstances aren't as much of a determining factor of our outcome as much as it's the decisions that we make determine the outcomes that we get. And so, even though all this is true, there are still new constructions. There are still people renting out properties. There are still people buying properties. There are still people operating with a very high efficiency rate inside of the real estate market. So, don't let the fact that things are different confuse you into thinking that things are impossible. And so when we're first going to start off, we normally would need to decide, well, all right, does that mean I sell, rent, or do I stay put? And that's going to be different for each one of us. For those that are leaning towards staying put, then the main thing that you're probably thinking about is, I already have a low interest rate. I have one of those historically low interest rates that Dre's talking about. I'm one of the reasons that the market has a low inventory because I'm not selling because I like my 3% rate. You would then be like, hey, look, I'm going to stay put. Maybe you have no mortgage payment. You've already paid off the home, and that works for your retirement plan. And you love the community that you're already a part of. Those are all reasons that you would say, you know what? I'm just going to stay put. If you were someone who was thinking, I'm going to move because I want to retire in a different place, then we can maybe rent in that place early going to see if we actually like it there. Now, if you were someone who was saying, well, I wanted to move for the weather, I wanted to move for some of the tourist attractions and things like that, or maybe I wanted to move to be with my grandkids. Well, then now you're just more deciding where in the area you want to live more than the actual location that you're going to live, right? You're like, I'm going to live in this city. I just don't know where in that city I'm going to live at. The more time that you give yourself, the better comfort you're going to have in making that decision. And so for many of us, we ultimately need to decide what are we going to do with the equity in our current home. If we rent, then we can sit the equity on the side. It can stay there, we can invest it, it can grow. If we take the equity and immediately buy our new property, then we're going to be entering into possibly a higher market. And depending on how that shakes out, I've seen it where it works, where you move to a lower cost of living city, and then the amount that you have covers that. And you're just fine to where it matches just great. I've seen others where it doesn't quite match, where maybe you have a smaller mortgage, but if that fits inside of your retirement income plan, where like I paid off half the house and then I have the other half in the mortgage. My plan wasn't to have a mortgage. I was excited to be debt free in retirement, but I was able to fit that adjustment inside of my plan. Then we can fit the adjustment inside of your plan. Because the way the economic cycles go, there will be a time where the rates will go back down again because that's the way the cycles go. They normally go down when we're very close or in a recession. Then so of course we're going to have a recession about once every 10 years. So the next recession, you'll be ready, you can refinance the home. And you can work that strategy. What we're saying is we're not trying to time the market in the sense that, oh, this is the bottom, I'm gonna buy here. Oh, this is the top, I'm gonna sell here. But what we are saying is we're going to make adjustments, recognizing what the cycles are. And based on what the cycles are, I'm going to go ahead and get my home. I'm going to deal with that mortgage rate that I'm going to have for those first couple years, or I'm going to rent and I'm going to wait and hope over the next couple years that we find ourselves in the lower interest rate environment. But whatever ultimately works and makes the most sense for you and your plan is how you would decide whether you're going to rent, sell, or stay put. When we're talking about downsizing, we're normally going to be thinking, oh, well, I'm going to have a smaller house, but that's not really always what's driving us. We're talking about downsizing. You normally want to start with what is the goal of downsizing? Do we want to be able to walk everywhere? Do we need to be in a community where we can walk to places? Are we trying to live by certain friends or certain events or grandkids, a certain family? Or is it the lower bills that we're looking for? Normally, when we're talking about downsizing, we're trying to simplify our life. That's really what all those things would have in common. My life, I want to simplify it as I get ready for retirement. I decide which of those is the most important to me. If there's multiple factors that I can consider, that's great. But I always try to put them in the order of my greatest choice to my weakest choice because oftentimes we don't get everything, but we want to be ready to know what is most important to us. And as we've already been sort of discussing, it's very important to recognize that just because you downsize doesn't mean you automatically have a lower monthly payment. That the interest rates could cause me to have a higher monthly payment. The HOAs, if I'm living inside of a community, could cause me to have a higher monthly payment. We haven't talked about the electric bill and the taxes, different things. All those could cause you to have a higher monthly payment. So we want to take a look and see what our actual monthly payment will be in the new community, all in, versus where we're currently at, all in. Because oftentimes what we do is we're comparing the best of our new situation to maybe the worst of our current situation. And that's not really apples to apples. We want to make sure we're comparing everything exactly accurate so we can make a sound financial decision when it comes to what makes the most sense for us. But because the inventory is on the low side, it's probably worth noting that you want to be ready to go. You probably want to have your pre approval ready to go. You probably want to have that relationship with your agent where they're sending you some of the homes. They want to be a little bit flexible in your time to be able to go see it. It's not as hot as it was where everybody's doing over asking price and all that crazy stuff, but it is still a low inventory market. So you don't want to waste your time. So you want to already have everything lined up, what's most important to you, the areas that you want to be in, the price that you're willing to go up to, and it still work for your plan. The more preparation that you put in, you'll often hear me describe the idea of wisdom readiness is there are opportunities and challenges in retirement. I want to be ready for both of them. I want to be ready for the opportunities and I want to be ready for the challenges. So I want to have the risk protection for the challenges, but I want to have the money set aside for the opportunities if they so present themselves. Now, if you're someone who was looking at real estate more for the rental income and you're not sure that you want to be in these bidding wars or you're not sure how difficult it's going to be for you to be able to enter the market, then we could look at real estate investment trust REITs. I do enjoy them a lot. You can have these projects where you're basically like a silent partner. So what ends up happening is there's a fund and they would own all the malls or they own a bunch of apartment complexes and they have an investment fund and then they get a stock and the stock ticker and you can purchase some of those shares. They take your money and then they go and buy these big, huge real estate properties. They run them, they reestablish them, they do all the hard work, and then you are sent some of the revenue from the successful real estate project. So REITs are very nice for people that want to have a passive income. You won't hear me say the word passive income very often, but this is one of those where it's designed that way, where for them to get the tax breaks of a REIT, they have to pass off, of course, the 80% of the revenues to everyone who owns the stocks. And so they're incentivized to do it. You're incentivized to give them the money. It is probably worth knowing that you're going to put a lot of work on the front end to choose the right REITs. Every REIT is not a slam dunk, but you find that them, as far as the rental income and what we can see as an income stream, there are some very good choices out there. And they do, generally speaking, pay more as far as a dividend payout than you'll find in a normal, typical dividend fund. That the average dividend fund in the S&P 500, I believe, is like 2.5%. If you were to look at the REITs, the number is double that at least. It's probably closer to 6 to 8% on average, but it's not impossible to find a 10% payout ratio for someone who has a REIT versus someone who has just a typical dividend. Other reasons that people like investing in REITs is you don't have to worry about the repairs. You don't actually have to deal with any of the tenants. You don't got to throw people out that aren't paying you anything. You don't have to get the phone calls and manage everything, collect the money, give out the receipts, make sure that they're not sticking holes in the wall and all that other stuff that goes with being a landlord. You just get the benefit of that. Now you are paying some of the money to the fund who's doing all of that, but for many people that ends up being a strategy that works for them very well. Next is to recognize that renting doesn't have to have the negative stigma where everybody wants to own a property. Owning is the best way to go. Renting is definitely an option, and depending on your own lifestyle and situation, your retirement goals, renting might be the thing for you. Now, the question becomes how long should I be renting? Because the benefit that you receive as a home owner is your mortgage payment is set for 30 years, and that payment ends up being a smaller and smaller percentage of your income as everything else goes up in prices. That there was a point in time that people had a mortgage of $1,000 and they had a car payment of 250. And now people have a mortgage payment of $2,000 and they have a car payment of like $900. And then in 10 years, 20 years from now, don't be surprised that people have a car payment of $2,000 and they have a mortgage payment of like 3,500. That's just kind of how inflation works. So as everything goes up in prices, sometimes it's nice to have something that's set at a lower price. That someone who has a mortgage from 30 years ago, that is much lower than someone who gets a mortgage today. And so that does free up a lot of money into your retirement, but you have to wait for that money to free up. And so for some people, it's something where they recognize that I'm taking a little bit of a gamble because I'm going to have my rent increase. I don't know when it's going to be increased, but unlike a mortgage, I know that it's going to be increased. So then that means I'm not going to get that space to be able to breathe on my mortgage payment because my rental payment is going to increase over time. That is something that we want to think about. Now, why some people renting works for them is because they don't want to have to do any of the maintenance of the house. Now, in a lot of situations, you don't have to spend as much on the maintenance and the repairs and fixing things because there's a landlord that's supposed to do that. And that's normally covered in the rental agreement. People who are renting also have the flexibility of not being stuck in any one city. They don't have to worry about selling the home. If they want to live in this state, they can live in this state. This country, they can live in that country. They can move a little bit more freely than someone who lives at home. If you are someone who plans on moving around a lot, then renting might be an option for you where you're going to live in Italy for a year. You're going to live in Florida for a year. You're going to live in New York for a year. Then renting for a year is probably going to be okay for you because it's almost a part of your retirement plan. It's lower than having an Airbnb, but it's higher than if I had a 30-year mortgage. But if I wasn't going to stay, think like a military family, they don't buy every city that they go to because they know that it's difficult to sell. And I don't want to be required to sell at a lower price because I have to move in a certain amount of time. If you need flexibility, then renting might be an option for you. And then as you're renting, if you sold the home that you currently have, you have that equity that's either invested and growing, or you're using it and spending some of it to fund some of these cool trips as part of your retirement. That if you were to sell your home and then you were to pay to live in Italy for a year or Greece for a year, and you can come hang out with us in Nigeria for a year, and then you can come hang out with us in Florida for the next year, you can see that I'm not actually spending too much into my equity, and it's possible that my investments are outpacing what I'm spending. And so now I still have this nest egg that whenever it is time for me to purchase a home, I'm able to still do that. And so you don't have to look at renting with this negative stigma. It's not an awful thing where again you'll see that people are comparing the best of one to the worst of the other, but it's very reasonable to say, depending on what your retirement goals are, either one could work easily for you. And that's why I tell people two things. One is keep the goals in mind, and two is don't watch the news because if you watch the news, they're going to be telling you, oh, it's the housing prices, there's no inventory, interest rates are high, and the world is burning. And they go, like, dang, if the world's burning, what should I do? Should I? And then you'll be like, I need to go do something. And then you'll react emotionally versus with your wisdom. If you're someone who's sitting there with like, these are the goals, how do I accomplish this? Does renting versus owning bring me closer or further from my goals? If they don't impact it in either way, they just make whatever the best decision that helps you sleep at night is. If there is an actual impact in the outcomes that you're able to achieve, then we should make the decision that helps you achieve whatever that goal is a little bit better, a little bit quicker, with a little bit more flexibility. So ultimately, what I'm telling my clients is number one, real estate is still powerful. You're not going to hear me say, oh, yeah, real estate is dead because that's clickbait. Real estate can't be dead. It's real estate, and there's only so much of it, and we're not building new amounts of it. Now, granted, I did see as soon as I said it, it popped in my mind. I did see where China was out building islands where they had like dirt and they were shooting dirt from their warships into the middle of the ocean because they're trying to build an island. So outside of them building an island, there's no new land being built, which I thought was actually pretty interesting. And you probably should Google it because I'm going to avoid the desire to go on that side tangent because I read the most interesting and boring things depending on whether you like or don't like the stuff that I talk about. Number two is I normally tell people, hey, look, it's not about timing the market. We are not in the game of timing the market. It's always time in the market. High level, the stock market goes up over time. It feels like we're having losses in the interim, but we know when you look at it from 2000 2025, it's gone up. When you look at it from 1950 to 2025, it's gone up. Now, granted, your retirement may not be that length of time, but what I am saying is that over time it does go up. Same with real estate. It's very difficult to look at real estate over a 10, a 20-year span and to find property that is a lower price now than it was. Now we can say, well, prices went down a lot during COVID. Okay. You can say prices went down a lot during the Great Recession. Okay, also true. But can you, over a long period of time, over like 10 years, tell me that the values of real estate have gone down and stay down? And I'm finding that to be very difficult, which means that we would be looking from a long term perspective of what helps us to accomplish our goals. Long term in retirement is getting this property at maybe a slightly higher price, but I can start generating a rental income, set me up better in retirement than just avoiding real estate altogether. Because that's ultimately what the question is, because these markets do adjust It's just in economic cycles. And we just want to be comfortable and confident, recognizing that those cycles have continued to happen. It's just like the regular seasons. There's 4 seasons, there's 4 economic cycles. It's very unlikely that you'll go from winter to winter. It may feel like, hey, I think spring should have started last week. You may feel like it's taking a little bit of time, but deep down, you know that spring is going to be coming. It's just maybe a week late. That's how I feel about a lot of these cycles. It is very difficult to go from economic growth to economic growth, but it's not difficult to go from economic growth to peak. It just peaks. It can't go up forever. And then when it peaks, it goes down. That's what makes it a peak. And then we're in a recession. And then at some point, you hit the floor. We call that the trough. That is just the 4 economic cycles. It doesn't always go down forever. It doesn't always go up forever, but it goes up and down over time, depending on policies and the economic environments and what countries are doing. And last but not least, your retirement plan should have a housing strategy, a housing component in place. And whether you're talking about where you're going to live at, whether you're talking about how much is the cost to sell, whether you're talking about whether I want to sell my home to fund a part of my retirement, or whether I want to do a reverse mortgage to fund a part of my retirement, or whether I want to leave the house to the next generation as a part of my legacy plan, we really need to be thinking about how we want our housing to fit into our retirement plan. Now, for others of you, your housing strategy is your income strategy, which is fine as well. How many properties do I need? Where do I want them to be located? Do I want them to be near me, or do I want them to be in another state? Am I planning on living in this state for my retirement? Because my location then impacts that. Where I'm managing the properties now because they're all on the block I live at. But I don't plan on living here when I retire. What am I going to do with these properties? Am I going to manage them long distance? Am I going to pay someone to kind of landlord it for me? You have to be thinking about these things, and all that should be a part of your housing strategy. If you're feeling stuck trying to figure out how real estate fits into your retirement plan, then we should work on it together. I do that every single day. I help people 5 to 10 years for retirement take more clarity, control, and confidence into their retirement plan with more wisdom and less worry. If that sounds like you and you think it'll be beneficial for us to have a free conversation and see how real estate fits into your overall retirement strategy, I'll put a link in the show notes for you to be able to schedule some time on my calendar. As always, I'm Dre Griggs, certified financial planner and founder of Obsidian Wisdom. I'm thankful for the time that we have together. Until next time, stay safe and enjoy life.